People often assume that if you've got $3 million saved, that the IRS is going to absolutely wreck you. 40% gone, maybe more. What nobody sits down and explains is that a retiree with $3 million can pay a whole lot less, sometimes dramatically less, if they understand the tax code and how it actually works. That's what I want to walk you through today. The real number, what the tax bill looks like for a retiree in that position, and why it probably isn't what you're picturing. I'm Jason Solomon. I'm the owner of Tactical Investment Advisors. Most of my days are spent helping retirees figure out how to turn what they've saved into actual income without writing the government a bigger check than they have to. So here's what we're covering. How much federal income tax a typical $3 million retiree ends up paying, why their effective rate tends to be far lower than their bracket implies, and the factors that can change that number in ways that can catch people off guard. Let me introduce you to David and Susan, who are both 67. They've got $3 million, and most of it's sitting in IRAs and 401ks from long careers in corporate America. They want to spend $10,000 a month, $120,000 a year. Here's where most people's thinking falls apart. They hear $120,000 and they immediately land on the 22 or 24% tax bracket. It seems obvious, but it isn't. David and Susan are both collecting Social Security, $2,500 a month each, $60,000 combined every year. The IRS doesn't tax all of that. Depending on their other income, only a portion of those benefits are going to be federally taxable. So before we even touch deductions, Social Security's taxation rules are already shrinking what the IRS sees. Then you add a standard deduction. Married couples filing jointly receive a substantial standard deduction, which shields part of their income from federal taxation. That deduction amount is completely untouched. Now watch what happens when you stack these together. They need $120,000 to live on. $60,000 of that's going to come from Social Security. So they're only pulling $60,000 roughly from their retirement accounts. After the standard deduction, their taxable income is dropped well below what most people would guess. Oftentimes, they're nowhere near the top of the 12% tax bracket, let alone 22. So what does the actual tax bill look like? First, roughly $24,800 gets taxed at 10%. So that's about $2,400. Most of the rest falls in the 12% range. So when you work through that whole picture, their effective federal rate can often end up substantially lower than many people expect. On $3 million, I know that sounds low. It surprises almost everyone. But that's exactly why running the numbers matters and why we do that for clients before they make any big decisions in retirement. If you want to see what your situation looks like, there's a link below where you can book some time with me or Scott. Now, this part matters. That low rate is not a given. It depends heavily on where your money lives and how you pull it out. I've watched retirees accidentally double or triple their tax bill by making one wrong move. So let me show you the 3 things that can quietly blow up that low rate. The first is your account mix, and it's a big one. If David and Susan's $3 million were sitting in a taxable brokerage account instead of traditional IRAs, the whole picture changes. Money from a brokerage might be taxed at long-term capital gains rates. Might be 0, might be 15%. It all depends on all of the income. Some might not be taxed at all, like if they're selling assets on a favorable cost basis or harvesting losses. Flip it the other way. If most of their money were in Roth accounts, those withdrawals would come out completely tax-free, assuming that they meet the qualified distribution rules. 0 federal income tax on the withdrawal, same $3 million. Wildly different tax outcomes depending on which bucket it's sitting in. The second is a withdrawal size, which is how people accidentally climb into brackets they were never planning on. In our example, David and Susan only need $60,000 from their IRAs because Social Security handles the rest. But say they want to spend $150,000 a year. Now they're pulling $90,000 from their retirement accounts, and that pushes them deeper into the 12% bracket, maybe even into the 22% bracket. Their effective rate starts climbing, and at $200,000 or more in withdrawals, they're in a territory that kind of stings. At that point, every extra dollar has tax consequences. Most retirees never sit down and calculate. Here's another one that catches people completely off guard, and that's IRMA. IRMA is the income-related adjustment that can push Medicare Part B and D premiums significantly higher for retirees that are above certain income thresholds. The first threshold for married couples is well above where David and Susan are in our example. But cross one of those lines and all of a sudden your healthcare costs jump. Cross a higher one and it gets worse. Their federal income tax rate might look perfectly reasonable, but once you add IRMA, it tells a totally different story. all because of where their reported income landed in a given year. Here's a quick note on state taxes because everything above was just federal taxes. If they're in Florida, Texas, Nevada, or somewhere without income tax, they keep the picture clean. California, New York, and Minnesota add 5 to 10% on top of what we just talked about. Same retirement, same $3 million, completely different outcome based on the zip code. And there's one more thing worth flagging because a lot of retirees underestimate it: required minimum distributions. Right now, David and Susan are pulling only what they need. At 73, the IRS starts requiring withdrawals from the traditional accounts, whether they need it or not. If they've still got $3 million in IRAs at 75, the first RMD could go well beyond $100,000. That's income that they have to recognize whether they spend it or not. And it can shove them into higher tax brackets, triggering IRMA and potentially unravel the careful planning that they had done for years. So this is why getting ahead of it matters. Years ahead, not months ahead. So what should David and Susan be doing? 3 things. First, map your income sources by tax treatment. Know exactly how much is in traditional accounts versus Roth versus taxable brokerage. That tells you which levers exist and when you can pull them. Second, fill your lower brackets on purpose. If you're sitting in the 12% bracket with room before you hit the 22, consider just pulling a little bit more from your IRA or doing a small Roth conversion. You're paying a low rate now to avoid a higher rate later. That's the trade. Third, watch the IRMA thresholds. Know exactly where the cliffs are and plan your income to stay just under them. A few $1,000s of unplanned income can cost you far more than the income itself in Medicare surcharges. Here's where I'm going to leave you. A $3 million retiree doesn't automatically face a crushing tax bill. With the standard deduction, the way Social Security is taxed, and a withdrawal strategy around your actual situation, your effective tax rate can end up being genuinely low. But it doesn't happen by accident. The retirees paying the least amount are the ones who planned it that way, usually years before they needed to. If you want help building a withdrawal strategy that keeps more of what you've saved, the link below has everything you need to get started. We'll see you in the next video.